Good morning, Chris.
Good morning. Good morning, everybody. How are you?
Tell us where you're coming live from this morning.
Coming live from Massachusetts. We have our offices here in Rhode Island, so we have some work out this way today. So the weather is a little bit different than back home. It's actually cool, so I feel like I need a sweater. It's like 67 degrees right now. So for me, my blood is a little thin. So
Well, it makes sense here in Florida. Thankful for the nice warm weather we've got.
Exactly.
So jumping in this morning, thank you everyone for tuning in with Coffee with Chris. We are here every Thursday morning at 10 a.m. for about 15, 20-ish minutes, 20 minutes if it's an exciting topic. And we're just sharing a little nugget of truth with you guys. We're just trying to cut through a lot of the noise that we hear in the media and in the world and such, in terms of markets and real estate and the industry and everything. So Chris Galley, Chris has been in the mortgage industry this summer is 25 years. Along with his wife, who is also 24 years. So they have combined, 49 years together of experience and are a great team. So Chris, this morning, I thought we would talk about credit scores and debt load and all of that good stuff. The reason that I think now is a good time is there was actually just some numbers that came out showing basically as we're into the second quarter of 2022, some pretty startling graphs in terms of consumer debt and how it has increased. Now, we're not surprised by this, right? We're all feeling the pinch of inflation. Obviously the worst offender, gas, and groceries and everything that comes along with it. What the report has said is that more people are having to put expenses on credit cards just because they don't have, inflation's gone up and most people's salaries haven't gone up, to match the level. So I'm going to share these graphs, and then Chris, you have a lot of tips and tricks on credit scores and everything like that. So anything you want to share. So let me share my screen real quick with you. And then, all right, can you see the graphs?
Yes.
All right, so this one was one, as you can see down here, it's showing the quarters and where the consumer outstanding debt is. In this instance, this does not include mortgage debt. So we're looking at things like car loans, credit cards are the big one, things like that. And obviously, as you can tell here, this line right here is January, and then zoop, that is a drastic number right there, going from Q1 to Q4. Another way, so this graph here is much more like, it starts at 2004, so this is a much bigger picture, but showing the trends. Obviously, we all know what happened in 2008 here, right? And then people's budgets got a little bit better, and it looks like it's steadily, the debt steadily gone up until we hit about right here, is where it's hard to tell because it's, a much longer time period, but you can see this sharp increase right there in debt. This blue line here is the housing debt. So as you can see, that did go up, but not like as drastically as the non-housing debt here, which has a pretty steep curve. And I think that right there is what the reports have been talking about in terms of people's budgets are getting tighter, and they're having a harder time paying for, just the things, groceries, the things that you need. So obviously this affects us. This affects us in the mortgage world as people are looking to buy houses and such. Chris, can you give us an overview? How does credit or just debt in general and your credit score play into it when you're looking to buy a house?
Well, it's one of the main factors, right? You're looking at what your scores can be, where they should be. And, you know, we can go down to a 600 score on some of our government loan programs, but that's not the ideal place to be as far as your credit is concerned. So there's some tips to like get those scores up. I think to be considered good credit, they always say 670 or better is considered good. Below that is not so good, right? So what happens? I mean, you can just imagine this. If you don't have such good credit, you're going to pay for whatever you're buying. So if you go out and buy a car and you have a 600 score, you're going to pay anywhere from 8 to 15+% on a loan, which is just pretty much throwing money away. And the same thing happens for mortgages, specifically if you're going with a conventional loan. So when you talk about excellent credit, I think the score, you know, if you're over a 740 or higher, 760, you have excellent credit, you're going to get the optimal rate. So our main goal is how do we get our scores to that and maintain that? And there's a few tricks, you know, and things that you should consider and how to do it. And one is the obvious one is paying your bills on time. I mean, we all know that paying the bills on time, but in this type of environment where your gallon of milk costs you $5-6, your gallon of gas costs you over $6 a gallon, and you're driving to work. I mean, I think I filled my tank the other day. It was almost $100, and I have a car. I don't even have a truck. So, and fortunately for me, I don't drive too much, but it's still enough to feel like if I'm filling up my tank every week or every twice a week, that's a couple $100 in just commuting to work. And, you know, for anybody, that's a lot of money. That adds up a lot when you're paying, you know, anywhere from $400 to $1,000 a month in fuel, especially if you have a long ride to work. So how can we combat our credit to make sure that we maintain a good score at the same time? So when we do need to buy that car or we're looking to buy a house, we're going to be able to take advantage of the better opportunities that are out there as far as rate is concerned. So the other second big thing is like what we would say is I would definitely get on a program to where you're setting up an automatic bill payment. This way, you know, and even if you're setting it up as the minimum payment, at least to make sure that the payment is made, because, you know, things slip by. If there's a card that you might have used that you forgot about, you know, that, you know, you just used it and you don't use it often. And I find I think what we're going to see is a lot of people juggling cards about this around this time because they're using, as you could see, the spike and increase in usage. You know, you might be pulling from a couple different cards that you have, maybe one that you haven't used and you haven't been used to paying for it. So, you know, last thing you want is to have a late, because that's 35% of your score is based on timely payments. So if you miss one card, you're going to have a major impact on that score.
So what is that impact? If they miss one payment, or let's say it's late, a couple of days late, what's the impact?
Well, a couple of days late is different than being 30 days late. So if, for example, if your card is due on the 1st of the month, I mean, you have a grace period before you pay any fines or penalties. You know, I think most of them are grace period 10 to 15 days. You don't want to go over that 10 or 15 days for one, because now you're paying more. And if you're already maxed out, now you're getting paid. Now the minimum payment is being hit against you. And now you got a penalty on top of it. You're going to pay an overage charge. So there's all these extra fees that are baked into this. And, you know, if you're not paying attention to this stuff, it can really get out of hand. And before you know it, you're paying money on money you don't even really owe. So I would definitely encourage you to get on a payment plan. Just pay it right away. And once you go over 30 days late, that's when that hits your score. So if you're due on the 1st and then you don't pay till the 2nd on the following month, you're going to get hit with a 30-day late payment. And that's going to have a 35% negative effect on your score. So, I mean, if your score is around 600, or say it's around 700 and you go late, you could drop all the way down to, you know, 640 or something crazy, where now you don't qualify for that conventional loan. Or if you do, you're going to be getting hit for that interest rate. So how the mortgage side of it works, if you're doing a conventional loan, anything over a 740, you're going to get the optimal rate. But in increments about 20 points, you get a hit on that interest rate. So a 720, you're not going to get as good of a rate as you would on a 740. 700, you're not going to get as good of a rate as a 720 or 740, and so on and so forth, until you might be 1% or half a percent or 1% higher in your buying power, which could make a difference of hundreds of dollars a month, extra just throwing it away. So getting on the payment plan is good. And then your optimization on what your utilization is very important. So we want to try to keep those cards at to have the best score possible is under 30%. So if you have a balanced book, some people say, I'm going to pay each one down as fast as I can. I would encourage you maybe just balance them all out at once, because it doesn't matter if there's 1 or 2 or 3 that are overextended on the debt and you have one that's perfect. Those other ones are going to drag down that score, and it's going to have a 30% impact on your score. And I think it's very important to try to get them. If you can't get them to 30%, get them all close to 50%. Just try to get them out from underneath that 90 or 80% of utilization, because you 30% of that score, it's going to be affected. And that's a big hit. I think a lot of people miss the mark. And that's why I think it's important to make those minimum payments, and have that preset for yourself right out of the gate, and have it on a, what did I call it? Set up an automatic bill pay. Because if you're the type of person that uses it every month and then pays it every month, if you miss the mark that day, or it doesn't get reported that day and it gets reported as at the top of the utilization, it's a snapshot in time. So it doesn't matter. It doesn't recognize that you pay it every single month and you pay it down to, 0 or whatever you pay it to. It just knows that you are extended on your credit. So I've had a lot of those conversations over the years with people like, I don't understand. I pay my credit card off every month. I said, yeah, but you're showing the balance still when they reported the score, and your score is being affected by that. So try to make the payment like a day before it's due. If set up at least the minimum payments or some kind of payment. If you're paying it off every month, set up a big chunk. So say if it's $1,000 limit and you use pretty much $1,000, maybe make a $500 or $600 payment automatically, and then go in and pay off the balance if you want, whenever you typically do it.
So I forgot to say this at the beginning for all of our attendees. If you have a comment or a question you want to leave it in the chat. If you're unable to leave it in the chat, or you don't have the option, you can go ahead and text me, and I'll be watching for questions. So Chris, that's obviously preventative is key, right? With everything. But let's say that you do miss a payment or whatever happens. I mean, I think people would be amazed. I think a lot of people who don't see a lot of people's financial records think everyone else has a perfect score except me. And that's totally not the case. Life happens to everyone, and so they get in a situation where something has taken a beating on their credit score. What are some tips that you have that they can do to increase their score, especially if they're thinking of stepping into the home buying or and such? So give us some tips on if they're, in the bad zone.
Okay. So one thing I would say, keep all your old accounts open. Here's a couple little tips. If you have old accounts, what you also see is people that say, you know what, I'm just going to get rid of these cards. I don't really use them that often. That will have a negative impact. So keep those cards, use them here and there just to keep them active. A lot of credit companies now, if you're not using them, you lose them. So keep some of those old, because that's the longevity. That's 15% of your score. That's a big chunk. So if you start getting this new card that's at 0% for the next 12 months and you pay off these other cards because you're going to just clean up your credit and clean up your act, that could possibly have a negative impact. I'd also encourage anybody that might have some challenge credit is join on an account as an authorized user, family member, mother, father, sister, brother. You'll on a card that maybe has a low balance on it that they've had for a long time, this will help springboard that score up. That will help you. Now, if you're coming from a place of no credit, that will not work. The algorithms have caught on to that. So you just can't go jump on a bunch of people's credit card, your mom's credit card as an authorized user. They're going to see that you don't have any of your own built up. So those algorithms have caught up. But if you have some challenge credit and you have a couple things that you kind of had a hard time with, or, kind of brought you down by doing this, it will really help bring that score up. Also, if you're a new person trying to get started and it's hard to get something, seek out a secured credit card. That's a great way to start creating some credit. And you want to make sure whoever you do that secured credit with, that they're reporting it to all three agencies. So you're going to get credit for that. You go to some of the big banks, Bank America, Chase, or some of these banks, they'll offer you, a secured credit card where you actually give the money that you're borrowing, which is counterproductive in a sense, but it serves its purpose to start creating and generating a score for you. So whether it's $1,000 and you just kind of borrow on your own money and you just pay it down to a good balance and it's showing that you owe 500, you end up getting your money back. You may pay $100 something in interest for that, but you're buying credit. You're buying yourself to get some credit. So that's definitely, I see a lot of new people. I would recommend any parent out there that has a kid that's 17, 18 years old, throw them on a couple of your cards with small balances as authorized users. Give them a head start because they're the next generation of home buyers. Set up your kids for success. I definitely would highly encourage that because it's going to be helpful for you. Handle any debt collections. Anything that you have, I don't care if you disagree that you owe the cable company that $100 setup fee that they put on your thing. To have a collection on your report that's going to drag your score down for $100 is not worth it. And I have these, and I'm not saying it's you that's watching or your clients that are watching this, but I see it all the time. They put them in dispute for pennies and it costs them thousands, in rate, and they end up taking care of it. So if you have these small disputes or collections, call these people. It's not going to go away. It's going to sit there and it's going to drag that score down. Even if you have to settle for less than full, ask for a deletion letter. Say, I will pay you this, but I need a deletion letter. And in some cases, most banks like myself can do what's called a rapid rescore, send those in, and it will be taken off your report as if it didn't exist. So you're going to write a note, right? When I pay off a collection, ask for a deletion letter. Be specific in that ask. Say, I will do this, quid pro quo. I will pay this debt. However, I would like for you to give me a deletion letter. Now, it's not going to work 100% of the time, but even if it works 50 to 70% of the time, it's going to help you on your score because it will act as if it's going to help you if you pay the debt anyways, but it will even help you more if it looks like it never existed and it never happened. So
I got a question. Someone asked about debt consolidation. If that's something that you recommend if they're looking to buy a house.
100%, because if you consolidate the debt but do not close out those cards, so pay off the debts down to the lower amount, so you're going to get the that utilization level down, but do not go and do debt consolidation, close out some cards that you've had for 5, 10, 15 years, because now it will have a negative impact because all of that time that they've been measuring you on for that card or that credit, that line of credit is now gone. So now when they do that snapshot in time, they don't have that history there anymore. Remember, every time they pull, it's a snapshot in time, and they take a look at where you're at that moment. So debt consolidation is wonderful. You'll get a small hit on one end because it will be a new credit that's opened. Opening new credit, having people pull your credit report does hurt your credit, and there will be a small hit to your score on there. But again, if you're paying down, a massive amount of debt that's overextended, that should outweigh any of the new credit pulls, because again, it's 30% of your score. And I stress, and I like to repeat myself so it really sinks in, do not close those accounts. I mean, unless it's one of those accounts where you have to pay like hundreds of dollars a year to keep the card open and you don't want to do it, maybe shut that one off. But for the ones that don't really cost you, they're on autopilot, keep them. One last thing I'll say, because now we're creeping up at 20 past, is I would definitely remember all of you who out there that have student loans, that they're going to start collecting that money again. I think it's in November. So just make sure you don't want to miss any of those payments. So any federal student loans, the forbearance period is going to end on December 31st. So just make sure to remind yourself that, to get those turned back on. So if they're not on auto pay and it comes, 2-3 years have gone like this, but now you're set into your ways of thinking, and you're used to not making that payment, and December will come and go. And then if you have a 30-day late on a student loan, that's going to hurt. And I don't think that they are on top of maybe sending out the bills and all that stuff as they should. So if their error by not sending it out to you, or you don't get the email, or you don't get the mail, it's not going to matter if it shows a 30-day late, and that will have a very negative effect. So please make sure that you understand, keep that in your budget moving forward, that those student loans will be coming due starting back in December 30th. You don't want to have that negative impact on your report.
We're going to be beating the hammer in December to remind people that it's coming up.
Exactly. So, I mean, I appreciate you guys for coming on. Please message us on topics that you want to know more about, whether it's loan programs you want to dive into. We can at least do small segments of that in 15 or 20 minutes, at least to give you a start. Remember that we will offer any virtual lunch and learns, where we can take 30 to 40 minutes of your time. We want to be here to serve and educate you. So again, we don't want to make you mortgage bankers, but at least arm you with information that your competitors don't have. So when you are trying to win over that buyer or that listing, you can say a couple things that are going to stand out compared to your competition. And that's really what we want to do. We want to arm you with, I know when I want to do anything, I want to educate myself, and I want to know more than the next guy. So you're in real estate. Part of doing real estate, for all our realtors out there, or even our buyers that want to know how to buy, you want the information, you need the information. Information is power, and we can give you as much of that information as you want. You just have to let us know.
Absolutely. Chris, thank you so much for taking the time today. We really appreciate it. If anyone wants this video later, we always post them on YouTube, and then send them out so you have access if you need to write down those tips again. But I hope everyone has a wonderful weekend. We'll see you all here next week.
Thank you, Mindy. Bye, guys. Good seeing you.